How's it going, guys? This is Forensic Forex with Deontay, where we analyze the details and specifics of the foreign exchange market. This is part 2 to a 3-part series on daily bias recognition. In this video, we'll be talking about entering trends with no indicators. Follow along. Today's agenda will be as follows: trend identification, counter trend candles, limit and stop orders. When it comes to identifying the trend, we know the trend formula from part 1. Higher swing high and higher swing lows lead to bullish trends. Lower swing highs and lower swing lows lead to bearish trends. This is very crucial in identifying the trend. If you haven't understood the trend formula, please go back and watch part 1. There are 2 types of counter trend candles: down counter and up counter. Let's define what a counter trend candle is. Candles that close opposite to the trend. That is its simple definition of what a counter trend candle is. Methodology. The time frame that we're going to be looking at is the daily. Once a bearish trend has been confirmed, wait for an up close day. Seek to sell at the close with a sell limit, or seek to sell at the open with a sell stop. On the right, we have an example of the DXY. We have a swing low broken, then a lower swing high, and then after we can see an up counter trend candle forms. That is the candle we're going to be selling at the close with a sell limit and selling at the open with a sell stop. Vice versa, we're still looking at the daily time frame. Once a bullish trend has been confirmed, wait for a down close day. Seek to buy at the close with a buy limit, or seek to buy at the open with a buy stop. On the right, we have an example of British pound versus US dollar. We can see a swing high is broken, then we get a higher swing low, and then shortly after, a down close counter trend candle unfolds. This candle, the down close, is where we're going to be buying at the close with a buy limit and buying at the open with a buy stop. Simple approach. Now, this approach is very simplistic for all levels of traders. Now, many traders may not have the time to sit and watch charts for a very long time because they either have a full-time job, they have children, they have a spouse, they have a business, etc. They have other things going on outside of trading. However, this simple approach can be really taken to find ways to get into the market and get into the trend. Buy after down days in a uptrend. Sell after up days in a downtrend. This is a very simple approach. Nothing more, nothing less. Let's take a look at some examples. Here we're looking at a bearish example of the DXY. We can see a swing low is broken, which sets the bearish stage. After that, we get a lower swing high that forms, what equals our bearish trend. And then we get a up close candle. You can see here, I marked off the open and the close. We have a sell limit at the close, and we have a sell stop at the open. So we're either going to be selling on strength, so price going up and hitting that limit, or we're going to be selling on weakness, price coming down and hitting that stop. Let's take a look at what unfolds throughout the rest of the trend. We can see after every up close candle in this downtrend, there was selling occurring. In order to arrive to this conclusion, or to be able to utilize this simple approach in counter trend candles, we needed to understand what the trend was. By following the trend formula, we were able to understand that price was most likely going to go down. After that, all we had to do was wait for up counter trend candles to then sell. Every time we had an up candle, it was a potential opportunity to get into the trend. As you can see, after these up close candles, price sold off. Looking at a bullish example for British pound versus US dollar, we can see a swing high is broken. After that, a higher swing low forms, and then we get that down counter trend candle. We're going to be buying at the close with a buy limit, and we're going to be buying at the open with a buy stop, meaning we're either buying on strength, so when price is going up, it's hitting us into our stop. We're buying on weakness, so when price is going down, we're getting triggered into the market with our buy limit. Let's see what unfolds within this trend. We can see price tends to trend higher after the counter trend candles. If we look at this chart, We can see after all the down days, price trends higher. Price trends higher after down days in a bullish trend. It is a very simple approach that I think all levels of traders can utilize. Here are some of my recommendations when using this entry. Risk small. You're entering on the daily time frame. Please take that into consideration when getting into a trade. Buying after down days in an uptrend is ideal. Selling after up days in a downtrend is ideal. Preferably, trade when the counter trend candle is in a small range cycle, not a large range cycle. This brings me to the end of the video. I hope this video was valuable to you as a trader. If you enjoyed this video, then I think you'll like these two as well. Please subscribe, like, or comment for more high quality Forex videos. As always, safe trading, leave the indicators alone, and peace.